All right, there we go. So today I'm going to go over order blocks and how you can use them for entries, like as well as targets. Um, we've had a few examples come up recently. I think I sent it on GJ. It's happened quite recently. Um, so what I usually do for order blocks is start on either the daily or the 4 hour. If you go lower, or like the 5 minute, the 15 minute, maybe even the 30 minute, a lot of the times they can just blow straight through. So I'm going to show you the confirmation I look for at these order blocks to actually enter. So if we look on GJ, I find they work a lot on pairs like pound pairs, gold as well on the higher time frames. I wouldn't use them on gold on like the 15 minute, the 30 minute, because the gold is because of the volatility, the lower time frames don't really seem to be as productive for me anyway. So if we actually look here, what we notice on the 4 hour is we've got, obviously we're in this downtrend. I know a few people in the group struggle with working out market direction. So the easiest thing to do is go on a 4 hour or the daily and just see where is price heading. Obviously here it's heading in a downtrend, so you're going to be looking for sales. So we've got this downtrend here. Some people would draw it in like a channel, something like this, like that, I don't know. Or you could just have that trend line up there at the top, just to give you an idea and to remind yourself that you are looking for sell positions, so you don't confuse yourself by going on the lower time frames. You might be down here, you might see this like double bottom sort of formation and think, oh, now we're looking for buys on GJ. But then you just have to zoom out and realize we're in a long-term downtrend. So it's not the best idea to counter trend trade. Just stick with the trend. On each pullback, that's when you're looking for the entries, especially with these order blocks, which kind of create double tops. This is when you can look for your entries. So as we can see here, you've got a lot of these highs, like these double tops being created, and then we fall. But you see here, an example of a perfect order block is one like, let me find a perfect one like this here. So what price does is pushes price up before then creating imbalance candles after it. Usually when you have an imbalance, it's been created by the order block before. And you've seen in the previous Zooms, and I know a lot of people are saying, how do I know whether the fib's going to hold or the order block? And a lot of the times, say the imbalance candles are very, very large. Like if we find an example, I'll show an example later on gold because it happens a lot on gold. And I was saying about using the 38% or the 23%, those sort of fib levels on the big imbalance candles. However, when it's like this, slow moving down, we create another order block here and then moving down again. This whole area here is imbalance, and this whole area here is technically imbalance too. And if you go on the higher time frame, you've probably even got imbalance on this whole area. Probably on the daily or the weekly, you've got a big imbalance down here. And the way you're looking for trades on this is either drawing a fib on these imbalances. So like this, drawing it across. Any fib levels work really. I'll add the 38 on there as well. There we go. So you see, when we're getting that immediate pullback, if I add the 23, I think it was. So if we're looking at these immediate pullbacks, that's when you get it between the 23 and the 38. So this immediate zone here. So on like the next candle after the imbalance. But when we're looking for price to come back up and then create a bigger drop down, we look for the 61 and the 70. You can use the 78 or the 76. They also work perfectly. But a lot of the times when you have that 78 percent fib, or some people use like the 88.6 or something like that, a lot of the times what price will do, it will come up and say the 78's here or the 88's here, it will tap into the order block with the wick and then close below on the body before then moving down. So that adds an extra confluence when you have price coming into the order block. And the same thing that happened here, the fib, we had 3 taps, price blew straight through it. So now we're obviously looking for the order block. And we do have another confluence. We have this downwards trend line, retail trend line, which obviously they do work. but I wouldn't trade solely off them, but it also is another confluence. What do we have in this area here? We have liquidity. When you have wicks like this, in one area, tight wicks, this acts as liquidity. And other forms of liquidity are like trend lines. So a lot of the times, say you have like a third tap on a trend line, a lot of people will be selling. So what is there above this trend line? Above here, there's money, because where all their stop losses, people are selling on this trend line, they're above here. So a lot of the times you'll see the trend line will break and then they'll get stopped out, the people that are selling from the trend line, and then the price will continue down. And a lot of times they just call it a fake out, a stop hunt, but it's just the banks collecting orders of all these stop losses above the trend line. So you've got to be careful with that, obviously, as well. But in this area, we do have a lot of liquidity here, which came back to test. Liquidity is like consolidation, or you could say supply and demand zones. It always has to be retested. So say price broke to the downside, created all these imbalanced candles. What do we have to do next? We have to fill the imbalanced candles. We have to grab the liquidity, collect the liquidity where it was created, and then we drop down. So say you're looking to enter off here. What could you do? You have your order block here like that. So you have a wick there and 1, 2, 3, 4, you've got 5 wicks here, that sort of thing. You could just enter off that first wick there. When we've gone into the order block, we've rejected the order block. But also you have the other confluence as well. Retest of the liquidity. We've respected the trend line. So this is where you could get your entry. If you don't get the entry there, you always have this entry here. So after we've held this order block, we've held this trend line, we've held this liquidity area after the retest, you could say we've created this sort of double top formation as well. I don't know if you use that as confluences, but price just dropped. We've created this big imbalance candle, also leaving behind this order block here, which as you see came back down and was instantly filled. So we had that filled. And what do we look for now? On the immediate pullback, came back 1, 2, 3 taps of the 38. So say you missed your entry up here, this would have been the perfect entry. You could have had your stops, above this wick here. You could have had them above these wicks here. Depends on what you want to do. And targets, you target the imbalance down here, which was also the order block. Yeah, you could say this whole thing is the order block. You can include the wicks as well. So you could say that there, or you could just target the bottom of the order block and also the bottom of the imbalance. So that there was hit perfectly. And that was a nice 1 to 12, 1 to 13. And if you got the entry on here, let's just remove this other one. Stops, you could have them just above this imbalance here. You could have it just above the fib, the stop just above the fib, but to be careful, price can always come back to this liquidity area to fill the imbalance and then drop. So you could have it just above the imbalance and you could have had the same target. So, just by missing that entry up here, you've gone down to a 6R if you win the trade from a 13 to a 6. So you've pretty much halved your win just because you missed the initial entry. But still 6% on a trade, anyone would be happy with that. You think on a 100 grand account, that's 6 grand profit. So that's how you can use them as entries. And if we go along here, we can find more order blocks. So we have one here, price came up and then dropped. However, price didn't actually break structure on this one. So the next order block we could look for is this one here. So we have this order block there, respected, dropped a bit. Why did it drop to here? You draw this across on the imbalance candle. It came down, filled the imbalance, 61%, 1, 2, 3, and then came back to the upside. Why did it come up here? Got this liquidity in this area, wicks, wicks, wicks. And also we do have this trend line as well, which, as we know, can work and does work in some cases. And then we did have price create another order block, and then where did it come back? Tested that order block again before dropping. But if we look at like a perfect scenario, if we go back on the I can't remember what pair I had it on, but a lot of the times when you have these order blocks on higher time frames, you can go to a lower time frame and find another order block in that other order block. So an order block inside the higher time frame order block. So if we go across here, wait, where was the example? Oh yeah, this was the example I was on about. I think I sent this in the group as well. So what we have is, if I create this order block, you could say this big candle is order block. A lot of people would. However, price didn't break structure with this one. It came back up, and then price, remember I said, creates an imbalance after the proper order block. So we had the push up. You could even say these two candles here are the order block. And then we created that big move down. This would have ensured you got your proper entry. However, if you were using this order block here, remember I said you can use the wicks as well, because wicks are manipulation, and on a higher time frame, this would be just one candle. If we look on the 8-hour, maybe, yeah, as you see, there's one candle here for this order block, which we came into and tested. But how would you have got the entry in this one? So if you go down on a lower time frame, what can you see? You have these big imbalance candles here. And what have we learned? You can draw the fib across from the imbalance candles. You could draw it across these, but these have been partially filled. And when we actually look for sales here, price has filled all the order blocks up to this one here. So this area here up to there has already been filled. It's created another order block inside this big order block, which we have on the 4-hour, which we're looking to sell from. So if we look, 1, 2, 3 taps of the 61, perfect. This is where you would have got your entry. Stops could be tight there, could be tight above there. And target, where would you target? You could target this this wick here. You could target this full imbalance here. You could even target this imbalance here, which hasn't yet been filled. We've filled around 50% of this imbalance. You could say it's been collected already, but these are good target areas to have. And also in this area, we also have an order block, because this was the move down before price then went to the upside and created these imbalance candles. So what did price do? It came back up, tested the higher time frame 4-hour order block, rejected our fib, 1, 2, 3 taps, which is inside the order block. Remember I said people were saying in the mentorship group that they don't know whether to use the fib or the order block, because sometimes it blows straight through the fib. And that's why I was waiting for this Zoom to show you that you can use them both together. So we're using a 4-hour order block with a 30-minute imbalance and a fib all together. You've got all your confluences. You've got 3 confluences. You could say the 3 taps is another confluence, but rejecting the fib. Or you could say another confluence is you have the 4-hour order block mitigation. You have imbalance looking to be filled. You have a 61% rejection, and you have the 3 taps, which is creating liquidity, which then has to be collected, and then was collected here. Because remember I said when it has wicks like this, it creates liquidity. So order blocks are pretty much liquidity. They act as supply and demand zones. And what is an imbalance? Also liquidity. Because clean traffic here, what does price have to do? It has to come up and collect these orders in this area, which are also lining up with the order block. So it's kind of a perfect scenario here. And if we look, price did actually come back to this order block, but we didn't get a close below. And when you're looking at order blocks, the best way to do it is to wait for the first tap. Say price came up, tapped it here. So you didn't get that big reaction, that big drop, the same as we did on this one, because it's already been mitigated. Price has already came up, it's rejected the fib, it's rejected the 4-hour order block. So now if it comes back to the area, we're now no longer looking to enter on this order block. So now this order block is invalid. So now we're looking for the next one. Where's the next one? In this area here, or this wick even, but that's also been mitigated. So I know a lot of people just draw it from the bodies. Some people draw it from the wicks as well. That's just personal preference. You can backtest that, see which one works for you, and then you'll be able to choose which one's best for your trading style. Because a lot of people have found that, well, that I know anyway, that when they include the wicks, they get more entries. Whereas when they're using the bodies only, they might miss a few entries because price doesn't come up fully. It just taps the wick. How you can overcome this is actually using different time frames. So like we've done here, say they're waiting for price to come up to this order block up here. If we're including the wick, actually, it would have just tapped into the pip. And when it's tapped in like this, unless you're super, super quick on it, you're not going to get this entry, because when price is actually moving up like this, it's just creating this big bullish candle. And if you're not entering on that wick there and waiting for a rejection or a mitigation of this full order block, you're not going to get the entry. So that's why I like to look for different confluences other than just a tap of the order block, as we have here with the fib and everything in the same sort of area. If I look on a different pair, you have the same here. We have on AUD USD. I actually took this trade on the Finding Talent. So you had this 4-hour order block again. Prices came up, created this order block, created the move down, and then price came back to test it. And why we're looking for sales, we can clearly see we're in this nice downtrend. So we just need to remind ourselves that we're looking for sales and not buy positions, and that'll just keep us trading in the right market direction. So we had this downwards trend, 4-hour order block has been created. So now what we're looking for is price to reject in this area. So what we're going to do, we're going to scale down. We're going to go back. And what can we see? We can see price has created this sort of double top formation. And then we've created this move down. But also what can we see is this order block in here. So we have this order block in here as well. So this is where we get our refined entries. So let me change the color of this one. So the 4-hour one is red, and we'll make the 30-minute order block in the green. So price, came up to test it. We've had a wick in the 4-hour one, but also we've had this wick in the 30-minute order block. And what can you do on this imbalance? You could just draw a fib across from this imbalance to this imbalance, which haven't been fully filled yet on the 30-minute. And what does price do? Came up, tapped the 61, bearish engulfing, sorted. I don't know if you have been able to get yeah, you would. So remember I said in the other GJ example, after this has tapped the fib in the order block and then dropped, what usually does, it creates this imbalance. Then you can get the immediate pullback entry. So the exact same scenario as GJ. So if we look back on this one, I can't remember which example it was. Which one was it? But if you look back, you'll be able to see that I mentioned the immediate pullback after this order block tap was when you can get your second entry if you missed it. And that's the same thing that happened here. So if we remove this first fib on the imbalances here, you have this fib on the whole imbalance on the 30-minute. Tap in, you could have got entry there, or you could have got an entry on this tap in again here. And then you would have caught, this whole move down. And if you're looking for targets, you could have looked on the daily. Where could you have targeted? What do we have here? We have an order block, however, 50% filled. So the targets we're looking for, imbalance. Imbalance here hasn't been fully filled. So this is where we can target areas like this, or just target areas of liquidity. I do have a Zoom on liquidity coming up soon, just focusing on liquidity only. But like I said, it's those sort of wick areas acting as so-called support, which obviously when people that trade support and resistance, they get stopped out, they get stop punted, then price goes in their right direction. That's literally just the banks creating liquidity and grabbing that liquidity. So when we have it here, we have all this liquidity in this area. So you see wicks, 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 all these wicks in here creating liquidity. You know, we have hours and hours in here of just wicks, wicks, wicks. And then price grabbed the liquidity, came back up. So you could have just targeted this new liquidity here. So this liquidity here has been grabbed. This liquidity hasn't. So that's where I was personally targeting on this one. And we have that there. If we just change this back, there we go. So other targets, remember I said the imbalance down here. You could have just targeted the start of the imbalance, could have targeted the full fill, 100% of the imbalance. And, you know, you would have had 11%. So these trades, you're getting proper sniper entries. So you see on this fib, where is your entry? If you got the perfect 70% entries, you know, you would have got the entry right up here. Or even if you got the 38%, you're still getting these sniper entries. And a lot of people see my Instagram stories and all the trades I take, and it's all like on the top of the wick where I'm selling. And this is how I get these sort of entries. These order blocks, the fibs in the order blocks, and the imbalance all combined together, and you get entries like this. I'm not saying it works all the time, because sometimes you have those order blocks that just blow straight through. It might be because, you know, one side of the pair is gaining strength, or you maybe have a bit of fundamentals, or there's another order block that is more significant the price has to fill. If we look on gold, we can see what's happening on here as well. There'll probably be an example. If we gold, like I said, higher time frames are the best for this. So if we start on like the weekly, something like this, what can we see? So what do we have in here? You know, we have all this liquidity up here, which has to be filled. That's why I think gold is going to definitely buying. It's going to be buying soon. And then we're going to look to target 1830, 1810 first target, and then we'll look to 1830. But what do we have? We have this order block here, this whole order block. So we have a bit of consolidation, we have this up move, which created the down move, which also created the imbalance candle. And like I said, when it creates the imbalance candle, that's when you know it's a proper order block. And this is when we scale in. You know, we go down to the 4 hour, and then we look for our entries. So this is where it's created on the daily or the weekly even. So this is where you'll be looking in this area to sell. So 4 hour, we've got this consolidation here. Also, this liquidity over here, which remember I said has to be retested. So we've got wicks, 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 broken it, but price never came back to this liquidity. So we retested that liquidity perfectly with this tweezer top formation. And the reason I sold up here was on the 30-minute. So when you have consolidation like this, it's just building liquidity. So what is there above here? There's money above and there's money below. But you see all these wicks to the upside, these wicks on the upside. Price is moving price above. The retail traders are seeing all these wicks. They're getting excited. You know, they're selling because their support area is like this. That's their support area. So they're seeing, oh, we got loads of rejections. We're selling. Stops are above this consolidation. So wherever their stop losses are, that's where we're looking to target. So when we had this spike up above, I did actually have a sell limit at 1807.1, literally just above this area. That's where I had the sell limit. You know, we had a little bit of drawdown, but remember I said 30 pip stops, that's all you need. And then you'll be sorted pretty much. And that's what we had in this trade. How far did price come? You know, we had 25 pip drawdown. You know, it's not the best, but if we look back, is there any reason for this? If we draw this across, price, yeah, also we had this imbalance on the left. That's why I did say in the group, I'm pretty sure that 1810 was another area where we could look for price to sell off. Reason for this, order block, draw that across. The top of 1810 was the full imbalance fill, and also price, I didn't even realize this, but price came perfectly 3 taps into this order block, which we did have on the 30-minute back then, and then we dropped. So you could have even refined your entries even more. I didn't notice this, but that's another confluence added to the trade. So entries on here, could have got a tap on the order block. We did have a lot of volatility here. Price was going down, up, down, up, down, up. And a lot of traders don't want to enter on this, but it's best to stay out when it's like this, or you could buy up to then sell. That's what I like to do on gold. Say you're waiting for price to come up here to then sell, you might as well find a good setup to buy up to that level. So if we look here, you could have maybe got an entry on the immediate pullback here, caught the buys up here. Price came down again, 1, 2, 3. Say you entered on the 3 wicks. Stops either below this or had them at 30 pips, like I always say. Target this order block, and then sell when it gets that order block, or sell when it breaks above here. You're making an extra 2%. And then you're selling when it hits your sell area. And then what's this trade? It hasn't hit the target yet, but that's the area I'm looking to target at. 1776, 1778, that sort of area, which is the fill of this imbalance, which is also this order block here. So that whole order block there from 1779, 1777, like I said, the order blocks create the imbalance. So we have the order block, the imbalance. That's what we're looking to target. You could even just draw the fib across, and you could have caught these buys here or pretty much to the pip as well. But this is usually for the immediate pullback, so I wouldn't have entered on this. I would have waited for price to come down. So what we're looking for actually is price come down to this area, maybe wick into here, tap a buy limit or a buy that we're looking in that area, set an alert for it, and then close above the 70 or the 61, and then we'll be buying up to 1810 first target. And the risk to reward on this will be absolutely perfect. You can have your stops just below 1775. You could even have them just below this area. To be safe, have them just below this wick here. It's a bit of big stop loss compared to what I usually use. However, this move up 4%, you catch 300 pips. Could get a risky entry, 30 pip stop, and you're catching a nice 1 to 10. But I'd personally prefer to play it safe because you've got this liquidity below this area, these wicks, which was the pretty much weekly range. It was a few days of ranging last week anyway. So this is where we've got to be careful for price to pretty much come down to before we're looking for buy positions. So that's why I was standing up here to go down, collect these orders in this area, fill this imbalance, come into the order block, and then we'll be looking for buys to the upside, 1810. I remember I said that weekly liquidity is at the 1830 area weekly. So as you see, top of this, 1830, this is where the liquidity is. And also we do have this whole imbalance here, which we could look to be filled. However, perfect 61 rejection on the weekly fib, absolute perfection. But the full imbalance could still be looking to be filled. So that is always a possibility when you're looking for these sort of trades. So is there anything anyone doesn't understand so far on this? Was it all good?
That's all good.
Can I just ask 2 questions?
Yep.
On the fib on the GJ example, when it tapped 3 times, would you have taken that trade or would you have not taken that trade? Where's the order block next? The first example you showed.
Was that up here?
Can't remember. But there was one where it tapped the fib 3 times, blew straight through it, and then rejected off the order block.
Let me go on the 4 hour. I can't remember it. Was it this one here?
Yeah, that one.
If you took the trade, you could have took the trade and you would have had your stops either above this imbalance here, above this imbalance here. You would have got stopped out, but because of the risk reward of the trades like this, when you saw these entries up here or these entries here, one win is wiped out, 5 or 6 losses, 10 losses. So it doesn't really matter that you've missed the one loss. It's better to enter the trade than to not enter and miss the trade. So I've always said, if you're scared to enter, you'll never make money, because say you have a loss here, prices hit your stop loss, and you think, oh, the trade's wrong. I've got the complete wrong direction. I should be looking for buys. Maybe you don't want to enter now because you've got stopped out on the fib, and because obviously a few weeks ago, that's all I taught, the imbalance fib. So that's all you knew how to trade from this mentorship. So that's why I wanted to do this Zoom next, to show you that you can use the fib and the imbalance together. So if the imbalance doesn't work, the imbalance fib even, then look for the order block, and inside the order block, that's when you can use the fib again. So we have the example here. You would have been stopped out on this one. You got the free taps, you got the confluences, it's perfect. But then we would have had the extra confluences on this one here to then look for the downside. And even though this trade hit the stop loss, doesn't really matter. It's only a 1% loss. And then if you entered on this one here, stops just above there or even just above there, 30 pip stops, targeted this imbalance here, you've made 10%, 1% loss. And then you wait for the perfect setup again, trust in the analysis. You've got the market direction. We're looking for sales. You've just got the wrong entry. So stick to the plan, have a certain set rules for when you're looking for the trades. So this one didn't work out. You had the free taps on the fib. Oh, well, didn't work out. You can see where you went wrong. Price went to the order block instead. You can't predict whether price is going to hold the fib or go to the order block. So you've just got to trade what you see at that time and not think, oh, maybe if I enter this trade, it'll go to the order block and I'll be wrong. You've got to think, oh, maybe this fib will hold because I've traded this so many times and it's held. So why not just enter and sell? So, you could have entered here, stop loss hit. You wait again, you've got the imbalance, you've got the rejections, you've tapped the order block, collected the liquidity, and then boom, 10%. Now you've wiped out 10 losses just from this one trade because you weren't scared to re-enter when you're trusting your analysis, when the plan is fully there to take. I hope that cleared that up a little bit. But when you had these free taps, I wouldn't just enter randomly off a free tap imbalance. And that's why this was a perfect example here. When you had that free tap imbalance, that's when it hit the stop loss. However, when you have the extra confluences of the order block, the liquidity grab, the break, you could say break of structure when we broke down here, and then we immediate pullback, you've got so many more confluences, and you can see why these examples win more than just random imbalance fibs, because there's a lot more reasons for price to drop rather than just a random imbalance candle on any time frame. I mean, why would it want to drop? Whereas in this example, you've got many reasons why that first one didn't work, and why the second one worked perfectly with pretty much no drawdown. I hope that cleared that up a little bit. Let me see if I have.
On your AUD USD, you had the order block that you mitigated and then sold.
Yep.
Was it not mitigated straight away after it came back up?
What, this one here?
Yeah. Would that not be classed as?
Yeah, you could say the price did test it a little bit, but I know a lot of people look for like a 50% or a full order block fill. And I think that was probably like, 20%, 15% fill. It's the same with imbalances. When we create these imbalances, certain candles might have like a little wick up before we have the body. And some people could say, well, like here, we have an imbalance, we have a wick up, and technically that could have been filled the imbalance already. But that's why a lot of people draw the imbalances as a fair value gap. So what that is pretty much It's just another way of drawing them. You could say it's more accurate. I'll just try and find a good example. So yeah, so like here. So instead of drawing the whole imbalance like this, just from the body, top of the body to bottom of the body, what you can do with the fair value gap is just hold control on your keyboard so it locks onto the bodies and the wicks. Go to the previous wick, go to the wick after, and there's your fair value gap. So technically the wick before has come down to test this area. The wick after has tested this area of the imbalance. So now we've got this untested clear traffic area here. And I say it's the same with the order blocks. So prices, it's come up, it's tested it a tiny bit, but I wouldn't really say this is a full mitigation because you mainly look for that 50% of the order blocks. That's a good place to look for price to reject. And the best way to look for 50% is literally just add the 50% to your fib. You can get rid of some random ones. And if we draw it again here, you can see that first one didn't even come to the 50%. So I wouldn't say that order block is mitigated yet. But obviously you have examples like the GJ one, whereas if you drew the imbalance, not the imbalance, the order block even, just like this with the wick, it would have just tapped in and you would have missed your entry, like I said. Whereas if you're using this 8-hour order block or this 4-hour here, price pretty much came and, it didn't perfectly tap it, but as we're counting the wicks, it did tap the 50%. Like this, yeah, pretty much to the pip came to the 50%, which was also in line with our 30-minute 70%, which then closed below the 61. So this was pretty much a perfect trade. But yeah, I'd say when price comes up straight away, taps the order block, I wouldn't really say that's a mitigation. I'd usually wait for price to come at least 50% into the order block to then drop. Because otherwise you could be entering, the order block's been created. You have a little wick up, you could be entering like on the low time frames, you see the order block being filled, but you just need to wait it out. Price can take days, weeks even to come back to some of these order blocks. But when they do reject them, you can get some big moves, especially if you use like the 4-hour, the daily order blocks. You're pretty much sorted. And if you add these other complemences, you've got the imbalance, you've got the fibs. You could even add the session volume. Let's see if it lined up on this one. Session volume, you just click on the imbalance, draw it down to the low. Yeah, as you see, it wasn't really relevant on this one. However, you could also use session volume from previously. So you could say this one to this one. It wasn't really relevant either. So they're the complements that I used when I'm trading order blocks. I could see if there's any other examples. US30 is probably going to come up and tap this order block actually now. Oh, it actually has to the pip. I wouldn't sell just off this either. But as you see, tapped in perfectly. And then we'll see what happens. But the reason US30 dropped today, what do we have here? We had this order block. And we also had this 4-hour imbalance to fill. And this 4-hour imbalance here. Where was it filled to? To the pip. So, this was quite a nice, easy target to have on US30. If you drew the fib, yeah, it wouldn't have worked, but you would have got that immediate pullback. Up here. So you would have got 61 actually here, 50%. You could have caught some buys. Where would you have put your stop loss? Like I always say, below the imbalance candle. This is a prime example of why you should do it. Instead of just putting it below randomly, you would have got stopped out. If you put it below the imbalance, you're still in profit. How much? Yeah, you're up 3%. Would you rather be up 3% by having a big stop loss or risking it to be up 9%, knowing that you could be stopped out because price wants to fill that imbalance candle? I'd rather, use a bigger stop, and know that my stop loss, if it gets hit, price could continue to the downside because that imbalance has then been fully filled and price is continuing. Whereas if my stop loss is below this imbalance, that's when we know price can hold this level. If it breaks below, I'm no longer looking for these long positions, because then when price fills that order block or imbalance even, we then look for the next one to be filled, or the next order block, the next imbalance, so on. But the thing is with US30, if you trade it, it's quite interesting to trade because it literally just goes up. So because it is an index, they literally just go up. So yeah, you got to be careful shorting it, which I don't really like to do. But yeah, I hope this did help. I don't really have anything else to say about the order blocks, unless you've got any questions. Just
yeah, I do.
Yeah.
If you can go back to that first chart, the GJ one that you were
Yeah.
in there initially, the first example, maybe I missed it before, but you were talking about the 3 candles going down being, that could be considered as a whole order block. How is that, or why is that?
Which bit you want about?
Yep, just there, and
This.
you go down. Yeah, you said that whole area there could have been considered as an order block rather than the little one that caused the initial move before it went down.
I think I said this 3 candles were an imbalance.
Yeah.
Which was created by the order block.
Oh, okay. So I got it. All right, thank you.
So a lot of the times, it's like if we use the 8-hour here, you can probably see it better. If we go back, yeah, you can see here we had this little candle up, which was the last up move before we had this big move down. And like I said, if you're on the 4-hour, what we have here is price came down and created another order block here, and then moved further down. But if you're on the 8-hour or the daily, you have this whole area here, which is imbalance. So what does price have to do? It has to correct this whole move down now. And what was that caused by? That was caused by this order block here, which was the move which broke the structure. So we have this structure here, this liquidity below this area. We have this imbalance here, which we have to fill. So the liquidity we have to grab. We even have liquidity over here. So we've got many reasons why we had to create this move, and also had to fill this gap. So this gap back here from the 7th of May hasn't been filled. So we had this gap there. When oil market opened, it opened higher, never came back to correct it. That's another example. But I won't really trade off that. But so you have liquidity here. The order block has caused a structure to break, caused liquidity to be grabbed. We've collected the liquidity from here. Imbalance, what is that? That's also liquidity. And also you had this mini order block here. And what do we have down here? We have another order block. So this whole order block down here was the last down move before the up. Price came down, tapped into that, came back up. Where did it reverse to? Order block down, order block here, and then back up to the other order block, and then rejected, down again. So these are pretty much where you can trade from. If you know the imbalance order block, you know the fib, liquidity, that's pretty much all you need to know to trade. If you back test it and look on the 4-hour, the daily, and then the 30-minute, you could go down to the 50-minute to refine them even more. But I say 30-minute is the only one you really need. If you go lower, you just see loads of wicks. And I don't think it's really worth it. But yeah, definitely if you're unsure about which imbalance candle to use, just literally go on the higher time frame and you'll realize that the whole thing is imbalance. Because on the lower time frame, you might have loads of wicks. You might have little pullbacks in between the imbalances. But if you want to see it clearer, just go on the higher time frame. 8 hours usually good, or the daily even. And that's where you see it more clearly. But just trade order block to order block, or use imbalances as targets, and you'll pretty much be sorted. It's a good thing to backtest as well, because order blocks, they're fractal. So that means they happen on every time frame. Like this strategy, you could use it on the 1 minute. You could use it on the weekly. It works on every single time frame. So you can backtest it on any time frame. Just maybe use like a spreadsheet or save the charts before and after screenshots of how it's gone. And then you can track your progress like that and see, maybe I'm entering too early, or I'm not waiting for the fib projections, the 3 taps of the fib before entering. And that could be why you're losing more trades than you should be. But obviously that comes with practice and actually backtesting and mostly trading on the live markets, because trading is mostly psychology anyway. So that's what you got to master, trading on the live markets. So then when you master the strategy, you won't be held back by the psychology of trading live accounts. Whereas if you're trading live accounts from the start, you then have that experience with trading real money, your own money. So then you've got the strategy on lock, you've got the psychology sorted out, and that's how you become profitable. Rather than focusing on just one thing at a time, if you're trading forward testing or live trading, even small account, maybe start with, I don't know, 100, 250, 500, maybe. I'd say 500 max if you're learning, because you don't want to start losing loads. And with 100, you can't really risk 1%. 1% is £1. That's 10 pips, the lowest lot size. So you've got to start with maybe 250 to 500, in my opinion. But if you can do, £10 to £100, that'll build up your trading a lot. And then you'll be able to do 100 to 1,000. Once you've done that, then you can afford funding programs. That's where you can then use those funding programs with your trading knowledge to then use the withdrawals from those funding programs to then fund your own account. And that's how you become a full-time trader. But yeah, I hope this Zoom did help. There will be another one next week as well, and I'll go over liquidity on that one in more detail, rather than just saying Wix, because it is a lot more detailed than that, and how I pretty much trade liquidity and how you can recognize it as targets, as entries. That's also another way to get wick entries, because obviously liquidity is wicks. So if you enter on the liquidity, target the liquidity, you'll be getting out in the perfect places. So I hope this helped, and I'll see you guys in the next Zoom.
Thank you.
Yeah, man, thanks.
Cheers, Will.